Yes, Sirski. Y'all know the vibe, man. It's D-Waugh. Welcome to another segment of D-Waugh Wealth Talk. We're going to get into it because we got a stock market pullback. Praise God. Show me. I'm ready to go today, y'all. Let's get into it, you are. Boom. So today, we're going to talk about the little stock market pullback that happened this past, what the hell is today? That happened this past, was it Friday? Yeah, Friday. I think so. I don't know. It happened sometime the past 3 days. Today's October 13th. I'm pretty sure it happened on Friday, and I was geeked about it. You feel me? So we're going to talk about what exactly happened with that. Why did it happen? And we also going to talk about the differences between a pullback, a correction, and a crash. What to do when any of those things happen, and how not to panic, and how to stay ready for these types of events so that way we can get the opportunity and then make mad bread off of it. You feel what I'm saying? This is going to be a good one, y'all. Let's go, boy. All right, boom. Disclaimer, gotta do that first. Everything here is for educational purposes only. I am not a financial advisor. Do your own damn research. ChatGPT is free, you word. We only talking strategy. We talking stocks, all that. For me, money mindset moment. For y'all that don't know, our money mindset moment is our positive affirmations that we use to attract wealth to us. You feel me? So today is gonna be when everybody else panics, patience becomes profit. The market don't reward emotion, it rewards preparation. You can't time the market, but you can respect the cycle. You can't time the market, but you can respect the cycle. For me, that's gonna be a real segment today, y'all. So boom, before we even get into all the differences between a pullback and a crash, this, that, and third, first we gotta talk about what the hell happened Friday, right? Boom, got you, bro, right? Trump tweeted. That's it. He tweeted. No bullshit. The man just tweeted and the market pulled back 3%. To provide more context of what he tweeted about, it was out of nowhere, bro. Like literally out of nowhere. Half court shot, bro. Trump tweeted stating that China has been acting very hostile to pretty much all the other countries by stating that China has sent letters to all countries stating that they're going to restrict their trade with their rare earth minerals. Feel me? And China makes up like 60 to 70% of rare earth minerals that is on the earth. You feel me? Like everybody needs that. You feel me? For our EV batteries, magnets, AI chips, this, that, and the third. So everybody got I get the letter, allegedly, and they're like, what the hell? So Trump got the letter and tweeted about it. And he was like, yeah, China's acting real hostile. We don't know what the hell's going on. But you know what? I'm about to cancel my meeting with China. I don't know what the hell they got going on. They pissing me off. And then he followed up that tweet saying, you know what, on top of that, by November 1st, I'm putting 100% tariff on China. Market pullback. Like, you ever see Mike Tyson punch a civilian for no reason? That's essentially what happened. I wish I could see that. That'd be crazy. Imagine you chilling, Mike Tyson just goes, I don't like you. Ooh, that's my fault. But yeah, bro, that's essentially what happened, y'all. And I think that's the number one thing you want to look into when it comes to any type of pullback or crash or correction in the market is context. Why did it pull back? What is going on? Because the market is very irrational. We're all human. You feel me? So we react off of emotions. And a lot of people just reacted off of emotions when they saw that tweet and sold their whole portfolio, which caused the stock market to pull back. So evidently, y'all, that's what happened. That's called the pullback. That's caused the pullback. But now it's October 13th, 4:30 p.m. Stock market just closed. And we had a big rally today. Huge rally. Not back to where we were, but I bet you we'll be there or above by tomorrow because we didn't even have a lot of volume today. Feel me? So that's what happened, y'all. Shout out to Trump's market. Feel me? Now let's talk about exactly D-Waugh. What the hell is a pullback? What's a crash? What's a correction? Was this a crash? Like, what's going on, right? So how it goes is if you see a 5 to 10% drop in the market, and when I say the market, I'm talking about the S&P 500 because that's pretty much the world index that has the top 500 companies in the world. If that drops 5 to 10%, that's what's called a pullback because you'll see that heavily reflected in all other stocks. You feel me? So that's called a pullback, right? And pullbacks are healthy. They're short term, they're quick, gives opportunities to buy the dip. You feel what I'm saying? Those are healthy to have. You don't want to have a market that just rallies all the time. Because if you have a market that will just rally all the time, things like Trump tweeted on Friday will happen when anybody is looking for a reason to sell because everyone is sitting on crazy profits and then everyone would sell their portfolio. You feel what I'm saying? So those pullbacks are healthy. That's signs of a good stock market. You feel what I'm saying? The market's really just taking a breath, chilling. People like me and you could go in and buy the dip. For me, that's essentially what happened Friday. It was a little pullback. It wasn't even 5 to 10%. It was like 3%. So I don't even know what would be considered a major pullback. It was just a little, for me, a little reliever for the market type thing. Boom. It's usually a buying opportunity. But remember, context. It's important to know the context on why something is pulling back, either the whole market or one stock. Now, a correction, boom. A correction is when you see a pullback of like 10 to 20%. You feel me? A correction. We haven't had one really in a while. Now that I think about it, bro. Because in April, that was a pullback. That wasn't really a correction because we never got to 10% when it comes to how much the S&P 500 had pulled back. You feel me? So a correction is, again, another sign of a healthy stock market. It's when the stock market pulls back 10 to 20%. It usually happens every year or two, and it's a normal sign, not really a sign of collapse. It usually is a catalyst behind it, either it be geopolitical stuff. I think the last correction we had was, I don't even know, bro. Was it Ukraine? Was it when Ukraine and Russia went to war? I don't know. But the one in April wasn't really a correction. That was just a pullback. So I'm not really too sure when the last one was, but it's completely normal. Happens every year or two, 10 to 20%. Feel me? Causes some emotional panic because obviously psychology, but it's normal. You feel me? Boom. Last but not least, we got a crash. Bow. Everyone's panicking. The world's on fire. Babies are flying out the window. What's going on? Boom. A crash is when you see a 20% up pullback. You feel me? Now we saw this the last time in COVID. Feel me? When COVID hit, we had a 20% correction. You feel what I'm saying? And with a crash, again, it's all context, y'all. Crash is something crazy. You feel me? Like COVID, all right, we thought the world was finna end. So everybody was selling that stuff. But then, here's the thing. There's always context, but the thing is with the stock market and geopolitical stuff, they're intertwined, bro. They're intertwined because on the charts, there's always a line, a support line. You feel me? And once the S&P 500 hits this line, there's always a big-ass bounce and rally. Same thing with COVID. COVID, there was a boom, crash, 20%. It hit a support line in the stock market. All right, Jerome Powell said we printing mad bread. Inflation rates, 0. Not inflation rates. What's the thing called? Interest rates, 0. Boom, everybody getting money. Stimulus here, stimulus there. Boom, boom, boom. Stock market takes off. And you may think, oh, D-Waugh, this is just a coincidence. Woo-woo. No, y'all. It happens consistently. Every time the S&P 500 hits this support line on the 10-year chart, it bounces. Every single time. So that's why I say context is key, because you want to know what the hell's going on and how quickly are they going to address it. You see what I'm saying? So the crash, 20% and up. Last thing that happened like that was in COVID. And this takes time to recover, but it all depends. You feel me? I would say the worst crash we had was for sure 2008. That was wild. That was 30%. I understand now why people were jumping out windows and shit. It was bad, y'all. You feel me? But the stock market rallies. You feel me? It always rallies. So there's one thing that y'all don't take away from this. Whether if it's a pullback, whether it's a goddamn correction, whether it's a goddamn crash, you buy the dip. You buy the dip. You buy the dip. All right? I don't care if Thanos himself pulls up at the White House for all 6 Infinity Stones. You buy the dip. I don't care if Genghis Khan comes back from the dead and said he's raiding America. with aliens from Mars. You buy the dip. I don't care if bro. I don't care if something wild happens. I don't care if dinosaurs come back. You buy the dip, bro. Because it's proven in stone. It always comes back, y'all. If we could come back from '08, we could come back from anything, goddamn. I swear to God. '08 was crazy. The whole world's economy almost freaking collapsed. Not even just ours. We came back from COVID when we thought it was the end of the world. Buy the dip, man. Just buy the freaking dip. But buy it smart. We gonna talk about how to do that. You feel what I'm saying? So boom. When we get into a pullback phase, the pullback, like I said, is a 5 to 10%. You relax, you kick back, you grab you a little cup of little something. I like my Ray and Nephew, so you grab your little cup of Ray and Nephew mixed up with some lemonade or whatever. If you're a true yachty, you mix it with the milk. You see what I said? And you buy quality stocks, man. And honestly, for either a pullback, correction, or crash, you buy quality stocks. You buy NVIDIA. You buy Microsoft. Hey, you buy Apple. They still a $3 trillion company. Shoot. You buy the Broadcoms. You feel what I'm saying? You buy the Googles. You buy the Netflixes, the Costcos. You buy the strong companies that have a proven game plan, that have a lot of growth potential still, that you know you're confident with investing in and not touching for the next 10 years. You see what I'm saying? That's across a pullback to correction to a crash. You buy strong companies because they add a discount. Feel me? You don't want to have a pullback or a correction or whatever and then buy into the still skeptical companies like the Oklos. The Oklo, hey, Oklo's running. If you got in the Oklo, shout out to you. You got mad bread. But they ain't make $1 yet. They ain't make $1 yet. There's a crash or a correction, I'm not buying Oklo. You feel me? I'll probably buy like an Iran, if anything, but I'm not buying an Oklo. I'm buying NVIDIA, keep it a buck, because if there's a crash, I know that NVIDIA is the strongest company, their profit margins are great, and that's never going nowhere. Feel me? So we buy quality stocks. We stick to long-term plans. Feel me? When I say long-term plans, I'm talking dollar cost averaging. You feel me? So we talked about dollar cost averaging before. But if y'all that don't know what it is, dollar cost averaging is when you buy a stock every day. Feel me? So prime example with me, I dollar cost average $5 a day to NVIDIA right now. And I've been doing that ever since like the beginning of the year type thing. Feel me? Now, I mean, I sound like, oh, yeah, $5 a day, that's not a lot. But it's all about the compound over time. You feel me? Because with dollar cost averaging, the magic is when there's a crash or a pullback or a correction, your $5 is going to be worth a lot more because you're able to buy more shares with the $5 since there was a pullback. Their share price is cheaper. Compared to now where NVIDIA had a nice little pullback, but NVIDIA probably going to touch 200 before the end of the year. I'm buying less shares now because the stock price is damn near all-time highs. Is at all-time highs. You feel me? So that's the power of dollar cost averaging. You get the best price and you don't time the market. You feel me? So that's what you want to do, man. Buy quality companies. Don't panic. And dollar cost average. You feel what I'm saying? That's all it is, y'all. That's all it is. And like I said, I don't care if Thanos comes back. I don't care if Thor comes back with the axe and the hammer. You buy the dip, man. You buy the dip. You cut out the hype stocks. You go to quality, profitable, strong, historic companies that's going to get you a bang for your buck, bro. That's it, man. Because y'all see things like this. Y'all see Trump tweeted, market pulls back 3%. Monday comes, we're up damn near 2%. About to be probably 4% by tomorrow when everybody comes back in the market because today was a holiday. You see what I'm trying to say, y'all? Now, one thing I want to say, though, during a crash, you still want to be, or correction or pullback, you want to invest smartly. You feel what I'm saying? You don't want to just put all your capital into the first dip. Feel me? So that's why I advocate for dollar cost averaging into the segments. You feel me? Dollar cost average. If you feel comfortable, let's say, it really depends on how much capital you have in your buying power. You feel what I'm saying? So if you're going to dollar cost average during a crash or a pullback, you want to make sure that you're doing it by a certain percentage of your buying power, right? So for me, what I do is I'm making sure I'm investing at least 10 to 20% of my buying power right now by buying shares at dollar cost averaging. And the rest, I keep loaded up for when there's a big dip so I can buy more shares, just trade all in, or I could trade with by buying options and things like that. But 10 to 20%, I think is a good gauge, y'all, because you don't want to load up all your capital in one dip and then it dips some more, then you have no more money. You want to be able to average into it over time. So I say 10 to 20% is a good range to start at, but it's all based off of your risk tolerance. You feel what I'm saying? That's it, y'all. Buy the goddamn dip, man. Buy, this is not financial advice, but buy the goddamn dip, man. All right, boom. So how you stay ready for the next dip? I don't know what's going to be, but for the next dip, how do you stay ready? You build up your cash power. So for me personally, what I do is I allocate most of my money goes towards my savings. I want to build up my savings account. Feel me? But everything else extra, at least putting in, I would say 300 per paycheck into my cash buying power, just to have that ready for in case opportunities like this come. You see what I'm saying? Keep doing that. Keep building that up. Keep building up that reserve to be like 10 to 20% of what you placing into your savings. You see what I'm saying? Keep investing into your buying power so that way you're ready for the next opportunity. Don't time the markets. Be ready for it. And we do that by automating our buys, right? So dollar cost averaging. Y'all can literally go into Robinhood. Y'all want to buy this stock every Monday through Friday, $5 a day. Boom, we'll do it for you. We'll take it right from your buying power. Feel me? So automate your buys so that way you're not timing the market, but you're always in the market getting the best price. You feel what I'm saying? And that's it, y'all. That's it. That's really it. Like, the stock market is not complicated, bro. It's really not, bro. You just find the good companies, and it's not hard to find the good companies. You could chat GPT. You could go look up on Zacks.com and the SPY, and it will show you the top 5 holdings of what's in the SPY. And you could just buy them shares. You just buy those stocks individually. You don't even got to buy into the SPY. Because those are the strongest companies that the investors and the hedge funds is buying. Feel me? It's not hard, y'all. Just buy the damn dip. Don't be soft. Feel me? It's green paper. All right? It's green paper. Investors, you can get some more green paper so that way that green paper could buy your freedom back. You see what I'm saying? It's just green paper, man. It's just green paper. Buy the goddamn dip. To end off, for those who are interested in starting now, obviously join our free Discord. Me and the Wolf, we drop free plays. I'm up damn near 60% year to date. I pulled back a little bit because of Friday, so I'm at like 41% right now. But before that, I was up 60% year to date. Wolf's eating too. Everyone in the chat's eating. If you want free plays, go learn it in the Discord. I would say my top 3 stocks that I would dollar cost average into, me personally, is NVIDIA, Zeta. I really like Zeta. And NU. Those are my top 3 right now, man. Zeta and NU are big growth plays. NVIDIA is just an animal. For me, I think you could buy NVIDIA whenever, especially now. I can see it being $300 a share eventually. Feel me? Buy the dip. You heard? It's D-Waugh. I'm out of here, man.